why we just try to take these simple rules for this RSI strategy that we were testing out. So one thing to keep note here, and one of the assumptions that we use is there's no transaction cost here. But one thing that we see is during this 2-year span that we were looking at, it came almost up to producing $40,000 from almost $40,000 in our equity curve that we were looking at. But at the same time, one thing to note here is that there was 7.8K trades that we took over that 3-year span. So even if we say we got the best spread and we only paid minimal spread, certainly that 7.8K trades will certainly take a toll on our profits. And that's always one thing to keep in mind, is because we're trading so often in a 1-day span, those costs are going to become really important as we trade on a short-term basis. We did it on a 1-minute chart, and this is from 2007 from all the way to 2009. Yes. Well, again, we basically put up this example because one thing to keep in mind here is that yes, when we take out costs, it looks very profitable. But once we add the cost in, it definitely varies. And these are just one of the strategies that we were running, and we really run a lot of strategies at dailyinflex.com, and we really try to build proprietary systems that can really benefit our customers. But at times it's really difficult because we have these costs associated with trading currency. So another strategy that I'll be discussing today is the grid strategy. So for those of you that aren't really too familiar with the grid strategy, it's actually not only used by a lot of FX traders, but it's used by a lot of equity traders as well. And it's a very simple strategy, and I'll keep it simple. But basically all we're doing is we're focusing on catching the ups and downs on a daily basis, and we're also focusing on intraday volatility. And we also, the one thing that we standardize in this strategy is our buy and sell orders will be very consistent, and typically all we do is if we set, and in my example I set 10-pip interval, is if we get a move in our favor, we trigger our entry, we look for that 10-pip rally, and then once it hits my 10-pip rally, I'll close that position and immediately open a new one and look for another 10-pip higher. So we'll go through the strategy, and I'll certainly talk about, sometimes it could be profitable, but again, there are a lot of caveats to a lot of these trading strategies. So here we just have, this is just an example that I made, and this is from April 1st that we saw. So one thing that we see is it's right around 0 to 100 Eastern time, and one thing that we see is price action is really moving up and down right around that 150, 135 level. So initially that will be the level that I'll look to start, or that I'll begin. So first thing I'll do is I'll set 10-pip interval, because we saw the high right around, and this is within the first hour of trading. We see that the high is at 135.08, and it's at 130, and the low is at 134.95. So it's really holding a tight range right now. So if I do see a break higher, and again, this is the first hour of trading, so if I do see a break higher, I'll look to buy in at 10 pips higher, but